Good morning, everybody. Welcome to the presentation for first half 2016 consolidated results of Unipol and UnipolSai. I am Alfonso Galante, the Head of Strategic Planning, Investor Relations and M&A at Unipol Group. Turmoil in financial markets during the first half of this year continues to be felt, and matters haven't been helped by Brexit. The knock-on effect can be seen in both the prices of the listed financial products and the appeal of life products, such as the unit-linked ones, whose heels are obviously tightly linked. Competition in the motor business remains strong, yet again impacting on the reduction of the average premium in the motor TPL sector. In this tough environment, the Unipol Group, however, recorded consolidated profits of 276 million euro compared to 151 million euro at the end of the first quarter this year. You may recall that results in the first half of 2015 were instead affected by higher focus on gains from financial instruments, so they cannot be compared with this year's ones. I will come back on this later on in the presentation. Breaking things down, this is how the numbers stack. Non-life business results were positive at 196 million euro. Life business was at 135 million euro. Other sector posted negative results of 56 million euro. Consolidated profit at UnipolSai amounted to 280 million euro compared to 140 million euro in Q1 2016. Group profit, net of minorities, was 160 million euro at Unipol and 269 million euro at UnipolSai respectively. Looking at the results of each single business area, let's start with non-life. The Unipol Group income in this segment amount to 4,011 million euro, slightly down year-on-year. Growth of 1.9% in non-motor business due to the good results booked by Unisalute was offset by a 4.4% decrease in motor premiums. As I said before, this is due to a fiercely competitive market in tariffs. I should point out that the customer portfolio has increased thanks to the first results of new actions stemming from our strategic plan. The launch of new products based on services linked to telematics and other insurance services, such as repairs through an agreed garage network, drives new business. These initiatives have partially offset the downturn in total income for the Unipol Group, which was 3,685 million euro, down 2.3% year-on-year, mainly to the decrease in motor business, while non-motor increase of 0.7%. Technical indicators in non-life business combined ratio at the Unipol Group was 96.3%, an improvement in comparison with 97.2% of H1 2015. Further improvement in non-motor business, which in 2015 was hit by a major claim because of the storms in Tuscany, that offset the negative effects of motor TPL caused by the decrease of the average premium. This item is made up of 69.3% loss ratio, slightly down on last year, and 27% expense ratio, almost stable versus the same period 2015. Combined ratio at the UnipolSai Group level reached the same way, stood at 96.9% compared to 97.8% in the first half 2015, showing similar trends in both loss ratio and expense ratio. Combined ratio from direct business, including the expense ratio calculated on written premiums, is actually much better, that is 94.7% at Unipol Group and 95.3% at the UnipolSai Group. If we drill down on the motor TPL results for UnipolSai solo, what we have got is a combined ratio in the area of 99% due to the decrease in the average premium being eroded by strong market competition. The average premium then gave up 3.7% over year-end and roughly 7% compared to the first half 2015. Positive signs came from the portfolio, which grew by 1.9% over the full year 2015, and from frequency, that was still slightly down on H1 2015, yet pretty much in line with the year-end. The other insurance companies in the Unipol Group, namely Linear, Unisalute and Arca Assicurazioni, overall posted results in line with H1 2015, with a total net profit of 29 million euro. Premium income improved by 5.3%, especially owing to Unisalute's performance, while combined ratio held at 87.9%, impressive levels. Turning now to the group life insurance business. As I said before, the tough operating environment has made it difficult to collect premiums from linked products. I must highlight that Group focuses a lot on this segment as laid out in the recent strategic plan. This driver especially weighted in on the UnipolSai Group, which experienced an overall decrease in income by 13.5% during H1 2016 and a drop in premiums from bancassurance companies. Impact on the Unipol Group was somewhat softer since the decrease in income was 4.8% due to an increase in sales by Arca Vita Group. The average minimum guaranteed on the segregated account decreased compared to the full year 2015. This gave us a safe cushion, being the same as the one we had last year, as we stated in our strategic plan back in May. This provides an overview of the non-insurance business, looking at the banking arm. This sector closed the half-year period basically breaking even. Initiatives to mitigate risks led to a further modest decrease in loans, which were 8,665 million euro, and to an associate fall in deposits to 9,675 million euro. From an economic point of view, interest income fell to 110 million euro, partly offset by the growth in non-interest income, which stood at 62 million euro. Starting from 2015, for the second quarter in a row, NPLs slightly decreased and are at 3,858 million euro. That's 40 million euro less than Q1 2016. The overall coverage ratio grew further to 45.2% with respect to the total NPLs and to 57.8% relating to bad loans. Let me take you through the group's investment management in the first half of the year. The asset allocation at Unipol Group was still focused on bonds, representing 87.6% on the total 63.8 billion euro investments. The second component was the real estate portfolio, which weighted in at roughly 7% of the total portfolio, whereas equity and funds and cash were only a residual part. The bond portfolio was made up by 67.7% of Italian govies and 8.1% of non-domestic govies, while the remaining 24.2% slightly increased in this period and was represented by corporate bonds. Asset allocation at UnipolSai was commensurate. Overall investment portfolio amounted to 53.6 billion euro. Profitability from financial investments stood at high levels, thanks to the positive yields from coupons relating to bonds still in the portfolio and the effects of a continued issuer diversification. The gain strategy, which has been reigning in comparison to last year, offsets the negatives linked to unrealized gains and losses caused by financial markets volatility and Brexit. This slide gives you the investments in the real estate business. Overall, the Unipol Group manages property for €4,216 million. No remarkable change here versus the end of 2015 need to be mentioned. Investments and purchase for €35 million were counterbalanced by depreciation, write-downs and other items coming in at €106 million. The UnipolSai real estate portfolio consisted of €4,054 million, of which 71% is allocated to non-life sector, 4% to life, 21% to real estate and 4% to other sectors. Looking at shareholders' equity, at the Unipol level it stood at €8 billion, €6.3 billion at UnipolSai level, a decrease compared to full year 2015 because of the dividends paid and the variation in the AFS reserve, which was in turn down essentially due to the equity investment trends. Solvency II ratios remain pretty stable compared to Q1 2016 ones. At Unipol level, the ratio stood at 1.4 times, while at UnipolSai consolidated level, it stood at 1.73 times. It's worth mentioning that the Solvency II ratio of UnipolSai solo stands at 1.94 times. I'd like to add that despite the tough market condition, I believe we have delivered a solid and sustainable set of results. That brings me to the end of my presentation. Thanks for listening. Please let me remind that our Group CEO and the senior management will be pleased to take any questions from financial analysts and institutional investors during the conference call scheduled today at 10 a.m. CET.